Welcome, ladies and gentlemen. I'm Jeremiah, and this is Jonah of the Cash Compound. And our mission is to crack the code to cash flow. We're going to help you understand a few secrets about money and finances that no one ever taught you, but that have existed in this country for over 200 years. And what that means is in this demo, we're going to show you how to save and spend money at the exact same time. This is growing wealth without ever locking your money up so you can't use it, giving up control to someone else or some other institution, or without taking risks with your capital. Yeah, so in this demonstration or presentation that you're gonna watch, we're gonna outline that for you exactly, how to get that done in your own personal life. And of course, we're gonna give you the examples and the numbers, the illustrations to back that up. So we look forward to having you watch this, and please reach out to us when you've done that so we can answer your questions specifically and help you get started. Thanks for joining us today as we talk through the cash compound and our mantra, cracking the code to cash flow. Today, this presentation is all about your money. We want to get your brain working and get you thinking just a little bit about the things that you've been taught that are true about money. The things maybe that you've learned that you think are true about money that maybe aren't true about money. We want to get your brain working on the way that money really flows and money really grows. We just want to challenge your thinking and explain that there possibly is a better way out there for you to manage your money, to grow your money, to increase your wealth without having to lock your money up or give it to someone else to control or take on additional risks. So this presentation is our Down with Debt presentation. It's an introduction to the banking concept. The reason we call it a Down with Debt presentation is because we're going to give you some examples today about paying off debt, using real people and real scenarios to show you how they were able to accomplish a huge debt payoff very, very quickly. We're also going to show you some other examples about some pretty cool things, if I do say so myself. We're going to show you today how to take some money, take $1 for instance, how to buy something with that dollar, maybe a candy bar. So now the other person has the dollar, but you've got the candy bar. And then we're going to show you how to get that dollar back as well. So you now have the candy bar and the original dollar that you purchased the candy bar with. Now, if candy bars aren't very cool to you or you're not interested in that, what if we did it with vehicles, car purchases? Well, we're going to show you that as well today. It's all got to do with this banking concept, understanding how banks work, how they operate, how you can take the place of a bank in your own life and finance your own purchases. And that's what we're going to talk through and walk through today. Zig Ziglar has one of my favorite quotes when we start this presentation. It says, "Money isn't everything, but it ranks right up there with oxygen." How true is that? Again, we don't want to be so focused on money that we lose sight of the other things that are important to life. But I tell you, I'm a little bit more at ease. I'm a little bit happier. Everything's going a little bit better when I've got a few more dollars in my pocket than when I've got less. So what we're going to show you today is just how to keep that money. But before we jump into any of that, I've listed out some money goals, some things that right now we're trying to do with money. So if it's okay with you guys at home here, I'm going to call money a dollar, a $1 bill, a $5 bill, a $10 bill. I'm just going to call it a means of exchange. See, that $1 bill, I can trade it in for a candy bar. So a candy bar is the same as the $1 bill, right? If you've got more money, $20,000 bills, you can trade that in for a vehicle. So a car is money, money is the car. All the money does is represent the exchange of the items, okay? So I venture to say that right now, anyone you're thinking of, their money goals, including yourself, are just a few things. One is to be able to buy the things you want and need, right? You got to support yourself, your family, whoever it might be. One of those main money goals is to buy the things you want. Here's the kicker though. If we really have enough money to buy all of the things we want, I bet one of our next money goals would be to give it away. See, if you have enough money, your pockets are overflowing, you can be a lot more genuine, a lot more generous to a lot of other people, maybe even underprivileged. And I bet that in the back of your head, you're going, that is one of my money goals. If I have enough of what I need, I can also help others. And so I want to help you guys understand that we can help you get there here today. Oscar Wilde says this, "There's only one class that thinks more about money than the rich, and that is the poor." All right, let's jump into it. All right, right now, where we are currently, again, let's talk about where we are right now. Most people are struggling with a few things. Most people are struggling with being in debt. Most people are struggling trying to have a positive net worth, trying to be worth something, trying to leave something to their heirs, to their family, to their beneficiaries, whoever it might be. And most people are interested in struggling or trying to manage retirement, having enough money set aside somewhere or coming in over time that they don't have to keep working forever. So my illustration to us is let's keep score for just a second here. I'm gonna go ahead and say that the average American, the average hardworking American starts working right around the age 18 full-time. Now I know lots of people start working before that or maybe after that or still in school, whatever. But if it's okay, I'm just gonna say average. And I also venture to say that right now where you sit, you've been told the same things that I was told when I started working. I was told to go to school and get good grades, but when I started work and started making money, I was told to put my money in all of these plans, qualified plans or programs. I was told by my parents, I was told by my peers, I was told from HR at work. And so let's just assume that this average American worker is going to do the exact same thing. The next number on the timeline is 59. Does anyone know, even you at home, why we've got age 59 on the timeline? It really should say 59 and a half if that's helpful to you. 59 and a half is the time period where you can finally access some of those funds that have been inside of these qualified plans. Now, it's not every qualified plan that you can get access to at 59 and a half, but the vast majority that are used today, you can access at 59 and a half. So what we have here with the timeline set up right now is that you are supposed to start working and supposed to be putting money into these plans or programs for 41 years where you can't touch the money. Again, this is what my parents told me, this is what my peers are doing, this is what HR at work was, the commercials on the TV, everything that I saw said put the money in the plans. So I venture to say that what we've been taught to do is lock our money up, in our example here, 41 years, into a plan or program where we cannot get to it or access it until we're 59 and a half. Right? All right, now I put another number on the timeline, and that number is 65. Again, 65 is on the timeline because this is when you can access the other portions of the qualified plans or programs, just depending on which one you've chosen. So it's either 41 years you're supposed to put money into the plans or programs, or it could possibly be add 6 more onto that, 47 years where you can put it into the plans and programs. Now maybe you didn't start at 18, maybe you started at 20 or 25 or 30 or 40. It doesn't matter. What we've been taught to do is put our hard-earned money that we could use to purchase things, to pay off debts, to increase our net worth, right? We've been taught to put it in these plans or programs, to lock it up in hopes that it's going to be there 40, 45, 50 years later, okay? Now, some of you might recognize why I put the number 70 on the timeline, and some of you might not. The number 70 is on the timeline because this is when you are required to take your money out of these qualified plans. They call it minimum distribution requirements. At age 70, you have to take it out of the plans. If you don't take it out of the plans, they'll actually give you a penalty for not doing it. Okay? Of course, I'm sure most of you know if you try to take your money out of the plans or programs before 59 and a half, you'll have the penalty as well. I'm not even going to get into taxes, right? Most of us understand that taxes are going to be there. I'm just talking about the penalty. So again, you're supposed to put your money into these plans. If you take it out early, they'll penalize you, even though it's your money. If you take it out or don't take it out even after 70, they'll penalize you. Again, even though it's your money. So we're supposed to put it away for 40 to 45 years, but there's really only an 11-year window, possibly just a 5-year window, where we're allowed to use our money without running into a penalty. The money that we earned, the money that we put away. It just doesn't look like the system that we see in front of us is set up for us. It looks like it's set up for somebody else. I just want to get your brain working just a little bit on what we've been taught and told. Let's keep going. Using that example we just saw, I've been taught to lock our money away, to put it somewhere where we don't have access to it. Even though we've got things to purchase and buy now, we've been taught to lock the money away. We've also been taught to give the money to someone else to manage, right? Again, understand what's happening in the plans or programs. Sure, you might be putting your money there to let it sit, but that means somebody somewhere else is using that money while it's sitting there. So we've been taught to give the money to someone else to manage, and most of us have been taught to take risks. Most of us put our money into plans or programs where there is a risk of losing it. I don't want to teach you any of those things today. I want to teach you exactly the opposite of those things today. Not lock your money up. Don't do it. I think you've got things to purchase and buy right now. I don't want you to give it to someone else. I think you can use it. I don't want you even to give it to someone else to manage. I think you know what to do with your money more than anyone else. And I don't want to take risks. I don't want to lose money. I'm sure that you don't. With the world that we live in today, you don't want to lose money either, right? Let's take a look at another example. This is one of my favorites. On the screen right now, you'll see guaranteed values versus market values. Again, lots of us are taught to put our money into things that have risk, like the market. Let's just take a quick example and look at it here. As you can see on the very left-hand side of this column, we've got years 1 through 10. The first kind of block there is a guaranteed value of $10,000. That is earning 4% interest. 4% interest is what that $10,000 earns. And you can see the values each year as you continue. So $10,400, $10,800, $11,200, $11,600, $12,100. You can see them all the way down. And 10 years later, you equal $14,802. Guaranteed to you. Well, over on the other three columns, they all talk about market values, and they all actually earn more money than what the guaranteed value is giving you. The guaranteed column is giving you 4%, where the market is going to give you 6%. But here's the catch. Over there at the market, there is going to be a loss just one time. We're going to show a loss once. The third column, is going to show a loss in year 1. The fourth column is going to show a loss in year 5. The fifth column is going to show a loss in year 10. A loss one time, but the other 90% of the time you're actually making more than what's guaranteed. You guys can look at the screen right here in front of you and see that 6% and 90%, 9 of the 10 years, but 1 year there's a loss. It actually doesn't matter. Look at the numbers here. Look at the totals at the bottom of the screen. It actually doesn't matter when the loss occurs. The numbers come out to be the same, 13,516. And of course, they come out to be less than what was guaranteed to you. Maybe moving a little slower, but in this example here, you can see that the guaranteed values, even though it was less, right? 90% of the time it was less. You can see that the guaranteed values actually came out to win. Here's the part that a lot of people don't realize. A lot of people don't realize. It's the chart on the right-hand side of the screen here. That if you have a loss with your money, you actually need to make more money than you even lost just to catch the person who didn't have a loss, just to break even. If you lose 5%, you need to make 5.3 just to get back where you were. You lose 10%, you need to make 11.1. You lose 25%, you need to make 33.3 just to get back even where you were. You lose 50%, you need to make 100 to break even. 75%, you need to make 300 just to break even. A lot of people overlook that and think, oh, I might have had a loss this year, but next year I'm right back on track. That means that over that time period of 2 years, you've actually lost money because you've got to make even more than you lost to break even, and of course even more than that to start making money again. Let's continue. Let's talk about how banks work. I told you this presentation was going to be about your money, about getting your brain to understand the way that money is flowing, the way that it actually grows, the way that banks use money. And so right now, let's dive into how banks work. In the center of the screen, you're going to see a bank. And for sake of illustration purposes, I'm going to be your banker today. All right, Banker Jonah. And since I'm your banker and I like you, I'm going to give you 4% interest on any money that you put into my bank. Now, I know 4% might seem outrageous to you, and believe me, I get it. These days, 2021, it's more like 0.4, 0.004 even maybe, right? But again, I'm your banker today, and I like you. So today we're going to do 4%. And let's just assume that you put $100,000 into your bank. Now, don't get hung up on the numbers. If $100,000 just does not make sense to you, then don't think of $100,000. Take a zero off. Do $10,000. If your $100,000 is too low, then add a zero on. Do $1 million. It's whatever you want to do. But for sake of the example, we're going to use $100,000. Now, with what you can see on the screen, you depositing $100,000 to my bank, where I'm going to give you 4%, I want you to take the place of the bank for just a moment. Take the place of a bank. At this juncture, when you've given me the money, is that money a liability or an asset to the bank? To the bank itself. It's a liability to the bank. The reason that it's a liability to the bank is because the bank now owes you 4%. You gave them the money, and now I, the banker, owe you 4%. So it's a liability that I have your money. I need to do something with the money in order to make that 4%, right? I need to do something with my resources. I need to actually perform an action in order to do something with the money. So can I let the money sit in the back, in the safe, in the vault, in the safety deposit box? No. If it sits there, I won't make any money. I won't have the ability to pay you your 4%. So I need to do something. So what business are banks in? Well, banks are in the business of loans. See, when you give that $100,000 to me, I now have that at my disposal. Sure, it's your money, but I have access to it. And so when someone comes to the bank, maybe yourself, maybe your family or friends, and they ask for money for a home, I'm going to lend them that money. But here's the key. Whose money am I lending? The depositor's money. The people who have entrusted the money to me is the money that I'm going to lend out. And when I lend it out, I'm going to upcharge it. I'm going to tack on interest. You can see it on my screen there. Now again, as we continue, don't get hung up on the numbers. Understand the concept of what's happening. You put money in my bank, I promise you 4%. Someone comes to my bank and asks for a home, and I give them the money for that home, but I charge them 7%. 7%. Every month they make their home payment, it goes to the mortgage company, and the mortgage company, the seller, puts the money right back in the banking system. Maybe not the same branch, maybe not in the same town, but right back in the banking system. And then I, as the bank, rinse and repeat. Let's do it again. Someone comes to me for a car, and I have money at my bank that depositors have given me, so I loan that money out for a car, and I upcharge them 8%. And they go to the car dealership, and they purchase the car, they give the money to the car dealer, and the car dealer puts that money right back in the bank, the banking system. Maybe not the same branch, maybe not in the same town, but right back in the system. And then, let's do it again. Someone comes to me and asks for money for a home remodel. I give them the money and I upcharge, 9% this time. They pay the contractor to do the work, and the contractor puts the money right back in the banking system. Someone then comes to me and asks for some money for maybe a debt consolidation loan or maybe just some credit cards, and I upcharge and charge them 12%. They use that money to maybe pay off credit cards or pay for things, and they put that money right back in the banking system. Who looks like they're in charge of these transactions? Who looks like they're managing the money very well? The bank, right? Me in the middle, the bank. Well, let's do some quick math to see how much money the bank really made. So, if the bank was going to give you 4% on your $100,000 deposit, and they upcharged for that house 7%, how much more did the bank make than you made? If the bank made 7 and you made 4, that means the bank made 3% more than you made. Let's do it again for the car. The bank makes 8% and you make 4%. That means the bank makes 4% more than you made. Let's do it for the home remodel. If you make 4%, the bank makes 9%. The bank made 5% more than you made. And again, for the credit cards, if you made 4% and the bank made 12%, the bank made 8% more than you made. So now let's add up all those numbers. 3 plus 4 plus 5 plus 8. How much more of a percentage did the bank make than you made? 20%. So if all those numbers equal 20, that means the bank made 16% more than what you made, right? You made 4, the bank made 16. Well, you're very close, but just a little far off. The bank made 500% more than you made on the same dollars rotating through the banking system. Think this through. If the bank made 20 and you made 4, didn't the bank make 5 times what you made? So if we convert that to percentage, it's 500% more than what you made on whose money? On your money. How much risk did the bank take doing all these transactions? Well, very little, right? Because if you're even too risky, the bank wouldn't have loaned you the money in the first place. Used your money to make all the money, took very little risk, and made 500%. If you research any bank you like, I have not come across one yet. A small one, a big one, a credit union. Think of one in your town and go look up their annual statement, their annual report. I promise you, you will not see a bank in the United States of America that has made less than 400% on the money that is left there every year. Most banks make between 400 and 1,300% annually on the money that we leave there as depositors. Crazy. What I want to show you today is how to take the place of the bank. I want to show you how not to lock your money away, how not to give your money to someone else to manage, and how not to take any additional risks with your money. And the way we're going to do that is by becoming our own bank, by taking the place of the bank. Instead of the bank being in the middle of those transactions, making all the money, controlling all the money, we want you to be there. The way we're going to do that is by using this cash machine. It is a dividend-paying whole life insurance policy from a mutual company. Now, I'll take a break. I'll pause. I know what I just said, and I know what you're probably thinking at home. You're going, what in the world does whole life insurance have to do with banking? By the time that we're done walking through this presentation, these slides, I promise you, you will understand that dividend-paying whole life insurance from a mutual company has more similarities to a bank than it does to insurance itself. More similarities to a bank than it does to insurance itself. So the first thing we're going to talk about is why we use this cash machine. And the first reason why is because this is what the wealthy do. I put some very familiar faces on the screen, some older faces, but I could give you plenty of current faces as well that use this method, this banking system for their own in order to build their wealth. Walt Disney used whole life insurance, dividend-paying whole life insurance to fund his first park. John D. Rockefeller used it as well. Ray Kroc used it for his first restaurant, McDonald's. James Cash Penney used it for his first store, J.C. Penney. You guys know these names and understand that this has been around for a long time. One of the other main reasons why we use this method is because this is what the banks do. Conventional banks, the banks that you know and love, have more assets in dividend-paying whole life insurance than they do in buildings and land combined. You don't have to take my word for it. You can definitely research this yourself. Search Google, do some research, go to the libraries, whatever you want to do, and look for BOLI, B-O-L-I. It stands for Bank-Owned Life Insurance, and you'll see that I'm telling you the truth. They own more life insurance, dividend-paying whole life insurance from mutual companies than they do in buildings and land combined. And let me ask you a question. If the banks own more than they do in buildings and land combined, if these very famous faces used it, do you think that they knew something that we don't know, or do you think that they're just stupid? Well, if you're asking me, I think they know something the average person doesn't know. And I'm here today to tell you about that and show you what's possible using dividend-paying whole life insurance. Before we can go any further, I have to make this very, very clear. Today, we are not talking about the types of insurance on the screen. We're not talking about universal life insurance, index universal life insurance, variable whole life, or term insurance. We are not bringing those up at all. I am talking specifically about dividend-paying whole life insurance from mutual companies. All of these insurance products have something going on with them inside the design of those products where this process does not work efficiently. And what I want to teach you today, like I mentioned, is how to become the bank, how to get in the center of that circle, as opposed to letting your money continue to pay for things and not earn as much as you could be earning. So, before I go any further, let me tell you my story. Again, just in case you missed it, my name is Jonah Du, and I have known about this concept of infinite banking, becoming your own bank, for just about 6 or 7 years. I was introduced to this concept on a webinar, just like you're watching right now. My background before that was in banking. I was a regular private banker at one of the banks in my town, where I live in South Carolina. And after I was done at the bank, I decided to move on into insurance, property and casualty insurance. I had a background in those two things, so when I saw this information that insurance could be used for banking, it just clicked right away. I've been able to now convert full time into teaching people just like yourselves exactly how this works and how they can use these policies to grow their wealth, to pay for things, to buy things, to pay things off, to accumulate more money, to have more money, to provide for their beneficiaries, to save for retirement. And I'm so excited to share it with you guys right here. Again, what we want to do is put you in the middle. Instead of the bank, put you in the middle, where you can have all your money working for you. You can be making money while doing all of these other things, while paying for the house, buying new cars, paying off cars, fixing the house, whatever you want to do, going on trips, whatever is your thing, we want to teach you how to do that. So, in order to understand it, you've got to understand just a few more things. And one is the strength of uninterrupted compounding. So, normally when we give this presentation live, we like to ask the question. We say, what would you rather have right now? Would you rather have $1 million right now, or would you rather have the sum of a penny doubled every day for 30 days? And normally when we're in a crowd, I hear people start shouting out, $1 million, I'll take the $1 million. You know, some people take the penny, but most people say, $1 million, I'll take the $1 million right now. Well, if you took the second to do any math and thought about what you'd really rather have, you would have been better off choosing the sum of a penny doubled every day for 30 days. Because after 30 days, that penny equals $5.3 million, which is a whole lot more than the $1 million that you would have got on the first day. Now, it takes 28 days for it to get over $1 million. But of course, as you can see, by day 30, you're up to $5.3 million. Let's stop here for a moment. And let's think about where we are now, how powerful that money is to sit there and compound every day. Einstein says that uninterrupted compounding is the 8th wonder of the world, right? Let's look at it, 5.3. But let's talk about compounding if there was a 2% fee. Now, most of you might admit and raise your hand at home, right, that sometimes some of the places we put money have fees attached to it. And a 2% fee, you might not think that anything, right? You might have brokers or people managing your money who are charging that, and you're thinking 2% is nothing, I'll take that. But let's take a look at our penny. Remember, we were going to end 30 days with $5.3 million, but now after 30 days, we're only at $2.9 million. That 2% fee just eliminated over $2 million. Wow. Does that seem like 2% of $5.3 million? Or does it seem like a little bit more? Let's do it again. Let's look at the $5.3 million we would have had on day 30 when there is a withdrawal on day 15 and day 25. Again, it's only a $100 withdrawal on those 2 days, so $200 total comes out of this platform, this program. But because the money wasn't there to compound, that $200 withdrawal actually cost you $3.2 million. Instead of finishing 30 days with $5.3 million, you just finished with $2,088,000. Wow, that seems like a whole lot more than the $200 that you needed on those 2 days. Let's do it one more time. Let's bring up taxes for the first time. What about a 15% tax? A 15% tax seems pretty modest. Sometimes these taxes can get pretty out of hand just depending on which tax it is. Again, remember that we would have finished 30 days with 5.3 million, but this time we're only finishing with $500,000. Here's the crazy part about the taxes. You only actually pay $182,000 in taxes. However, because that $182,000 was not there to compound, the tax actually cost a loss of $4.8 million. Again, you finished 30 days with $500,000. How many of you would agree that some of the places we've been taught have all three of those things going on with them? There's a little bit of a fee, somebody's managing, their tax is always going to be there, and just in case we need the money, sometimes we go and dip into it and take some money out. And we are wondering why we can't get ahead, why we're not making as much money as we should be making, right? The money's not there to compound. Uninterrupted compound can be so efficient and powerful if you let the money sit there. But who can do that, right? Who can do that? Let the money sit there. We've got things to purchase. We've got things to buy. Let's do one more, just so you see it. In this one, I'm going to give you an example of a car purchase. And in this car purchase, I'm going to be your banker one more time. So at my bank, just as I promised before, you get 4% on any money that you leave at my bank. And let's just assume you at home have $25,000 in my bank, 25,000 bucks. And you decide that you want to purchase a car for $25,000. So you're going to come into my bank and you're going to do a withdrawal. You walk into the bank, you walk up to the teller, and you say, "Hey teller, I'd like to withdraw $25,000. Now, because I'm the banker and I'm paying 4%, all right, I'm obviously have an office and I overhear you walk up to the teller and say that. So I come running out and I say, "Oh no, are you closing your account? Is something wrong?" And you say, "No, I'm not closing the account. I just want to purchase a car. So I'm taking the money out and doing a withdrawal, and I'm going to go purchase that car." And as your banker, I say, "Listen, don't do that. That's a terrible idea to use your money in this bank. Instead of using the money that's in this bank, let me loan you that $25,000 for a car." And of course you say, no, I'm not interested in a loan. I didn't want that. I don't want to have the payments. I don't want to pay any interest. I just want to go purchase that car. And I say, "Listen, I know you don't want the payments. I know you don't want to pay interest, but listen, I'll loan you the money and I'll charge you 6% interest. And I promise you that by doing my deal, you're actually going to come out on top. You're actually going to come out ahead in this scenario and make more money than I'll charge you." Would anyone call me an honest banker? Anyone? Call me honest. Instead of using your money and go purchasing that car outright, I'm saying let that money sit there. Let me loan you the money. Pay interest, 6% interest, and you'll come out on top. Anybody call me honest? No way, right? The first thing that happens in our brain is that we're going, if I'm earning 4%, but I'm paying him 6%, I'm losing 2%. So that he can't be telling me the truth. It can't work. Well, what if I told you the banker was telling you the truth? And let's take a look at it to prove it to you on these calculators. So, just like I mentioned, the savings account at the bank's got $25,000 in it, and you're earning 4% at my bank. At the same time that's happening, I said, let's loan you $25,000 for your car, and I'll charge you 6%. Now, the average note on a car is about 5 years. That's about 60 months. So that means each month you have a payment of $483.32. So now we need to add that up to see how much this car really costs. So $483.32, 60 times, 60 months, is going to equal $28,999. Now, I'm just going to round up to $29,000 if that's okay. But that means that your car cost you $25,000 and the other $4,000 went to the banker as interest, right? It makes sense to everybody? At the same time that that's happening, the $25,000 that you have earning 4% for the same 60 months equals $30,525. Now, I don't know about you, but where I grew up here in the South, they taught us that $30,000 was more than $29,000, right? What in the world just happened? The banker told you the truth, but our brain said there's no way he could tell us the truth. On that deal, what happened? Well, your savings account at the bank was on an ascending, an ever-increasing scale, while your loan, your car note, was on a descending, a downward scale. Every time you make a payment, that car is owed less on that balance. Whereas the savings account at the bank, every month that goes by, you now have more of a balance at the bank, right? So the banker did tell you the truth, but your brain played a trick on you. Your brain said, I cannot possibly earn 4 and pay 6 and come out ahead. When that's not the actual way that money flows. See, what happened here in your savings account at the bank was uninterrupted compounding. Uninterrupted compounding is what's at play here. Let's show you how uninterrupted compounding is at play inside dividend-paying whole life insurance policies from a mutual company. And we're going to use a car again to understand this just to make it easy. Now again, I know that I told you guys we're using insurance like a bank. I promised you that you're going to see that this insurance is more like a bank than it is the actual insurance. But in order to prove it to you, I'm going to go ahead and say it now. There are 2 things in insurance that most people know that today we are just not going to talk about. And those 2 things are age and death benefit. Okay? The reason we're not going to talk about age is because I told you today we're talking about your money. We're talking about banking. We're talking about cash. And when you talk about money, age does not matter. It does not matter if you're 20 years old, 30 years old, 40 years old, 50 years old, 60 years old. It doesn't matter. I can keep going. $20 is $20. If you all walk into the same grocery store with $20, everybody in your family has $20. You all walk into the same grocery store. There's not one person that's at an advantage to buy more stuff. You all have $20. Age does not matter. And the other thing we're not going to talk about today is death benefit. You know, I'm sure, with life insurance, there's a death benefit attached to each policy. If you decide to use a policy as a banking system, there will be a death benefit attached to your policy. But this policy that I'm going to talk to you about today is going to be more about cash than it is everything else. That death benefit's just going to be a bonus, just going to be a tag along, an add-on as a benefit to your family if something were to ever happen. So let's jump into it and let's talk about cash. So, in the 3rd column of the sheet in front of you, you'll see a policy premium deposit. The reason that we call it a deposit is because when you're using a banking account, a banking system, every time you put money into it, they call it a deposit. So we're going to call it a deposit too. And I know some of you might get hung up on an insurance premium, but any premiums, when you've got a policy designed this way, is a deposit as opposed to a premium. This particular person decided themselves to deposit $10,000 into their policy per year. Now please do not get hung up on the numbers. If $10,000 does not make sense to you, change it to $1,000. If $10,000 doesn't make sense, it's too low, change it to $100,000, whatever you want. I'm just trying to give you an example of that anything is possible. It's your bank. You can put anything you like into it. So they decided to deposit $10,000 in their bank for 5 years and then $4,000 for 2 years after that, for a total of $58,000 deposited within the first 7 years of their banking system. Their dividend-paying whole life insurance policy from a mutual company that we are going to set up to work like a bank. Now, as soon as that policy starts, over in the 6th column, cash value available. There is cash value that they can take and spend, use, blow, whatever they want to do from this policy. And you can see that cash value build over time. In the 3rd year, they have $21,000 of cash value available, and they're going to use $20,000 of that to purchase a car. With $20,000, they take it out of their cash value, and they use that to purchase their vehicle. At the same time that they do that, they determine that since they're using this policy as a banking system, and they've just taken money from their banking system, they should do exactly the same next step that banks do to them. See, if they would have borrowed this money from a traditional bank, the bank would have put them on a payment plan. Call it a car note. They don't have that here in this policy, but they've decided since that's what a traditional bank should do, and they want to be their own bank, that's what they should do as well. So when they take $20,000 out for that car purchase, they immediately decide to put in $400 a month, $4,800 all year for 5 years to equal a car note. $400 a month, $4,800 over a year for 5 years equals $24,000. That's the same exact car note that they would have gotten from a traditional bank. So that's what they put on themselves. Not a requirement, but they decided to do it. Let's take a look at the numbers, at the math, okay? Reminder that they borrowed $20,000 from their policy, their banking system, to purchase this car. And then they've determined to repay themselves $4,800 5 times, $24,000. Remember, the traditional person who purchases a car would never do that step, right? If they finance or lease the car, of course, they'd have to do the payments, but if they paid cash for the car, they'd never do that step. We're going to teach you and implement that you should, even though it's not a requirement. So again, let's take a look at the numbers. In their deposits into their banking system, they deposited $58,000 over 7 years. They then purchased the car for $20,000 and then repaid themselves $24,000. So that means their total is $62,000 of net money that has been injected into this policy. At the end of 7 years, the cash value that is inside their policy is $58,000. Without getting my calculator out and doing the math, I believe that's just around 91 or 92% of every dollar that they put into this policy they still have access to. And they have a 5-year-old purchased car in their driveway that they have had the entire time, paid outright, free and clear. Don't forget that part. 91% of all the money they still have with a $20,000 car in their driveway that they've owned since day one. But it gets better. Let's do it again. Maybe you've got family. Maybe you've got friends. Maybe you need another car. So cars don't last forever, so let's purchase a new car in the 8th year. In the 8th year, when we purchase a car for $20,000, we're going to get that $20,000, of course, from our $58,000 that we had inside this banking system. So we take $20,000 from the banking system and we use that to purchase a car. At that juncture, we decide again, even though we don't have to, that if traditional banks would make me put on a payment plan, I should be on a payment plan to my own bank, to myself. So $400 a month, $4,800 for a year, and do that for 5 years equals $24,000. That's what we're going to repay this banking system. At the same time that's happening, we've determined to put in $4,000 a year in as deposits to the bank. Again, they've changed the deposit amount. It went from $10,000 to $4,000. There's no issue here. It's their banking system. They can put in what they like. So let's do the math again. $20,000 is what they put in deposits over this 5-year stretch. $24,000 is what they repaid themselves for the car. And of course, they purchased a $20,000 car. That means that their net injection over this 5-year period is $24,000. But again, let's take a look at the cash value growth over this 5-year period. Our cash value went from $58,000 we had to $94,000 in this policy. That is a $45,000 growth over 5-year period with only a $24,000 net injection. And 2 paid for cars in your driveway. Been paid for the whole time. How do you like buying cars my way? With that second car purchase, how much did that car actually cost us? You made money, didn't you? Your cash value went up $45,000. You made money, didn't you? Your banking system has more money that you can take and spend and use. Again, with the car purchases. Now, I'm not going to sit here and tell you that it didn't cost you anything or you made money to purchase that car, because you had to get started with this banking system. And if you remember, back to year 1, when you deposited $10,000, you could only get out about half, about 60% or so of that money in that first year. It took time to accumulate. You had to give it time to grow this banking system. R. Nelson Nash, the author of a very important book, which I'll show you coming up here shortly, Becoming Your Own Banker, said it best. He said, every time you start a banking system, it's like starting a business from scratch. And most of us understand starting a business from scratch, it takes you a little bit to make the money. It takes you a little bit to get going. A banking system is similar. Over time, your banking system grows bigger, faster, stronger. And why is that? What is happening inside the banking system that makes it do that? Well, inside dividend-paying whole life insurance policies from a mutual company designed specifically to work like a banking system, the insurance companies guarantee you interest on any dollars that you deposit to your policy as premium. Those $10,000 we were putting in, $4,000 that we're putting in the example you can see here, that is guaranteed to grow over the lifetime of your policy from the insurance company. Guaranteed. And the most the insurance company can charge you for using their dollars are 6% interest. Here's the thing. We saw with our calculators, with our example before we jumped into this car, that it is absolutely possible to make money earning at 4% while we're paying at 6%. In case you're missing it, I'll say it again. The money that you take and spend and use from these policies is the insurance company's money, not yours, which means that all dollars that you deposit are uninterrupted, growing and compounding year over year over year, while you get to spend and use cash value to accomplish your purchases. This is the only place that I've seen in many, many years of looking, of teaching, of understanding things about money, where you can spend money and save money at the exact same time. But it's important to understand you're saving your money and you're spending their money. You're earning uninterrupted compound interest while you spend their money for the things that you need to accomplish. We're not locking money up where you can't get to it. We're not taking additional risk. We're not giving it to someone else to manage. We're keeping and using it to accomplish our goals while we still get the growth of uninterrupted compounding. Let's give you another example, and this is our down with debt example. In this example, we're going to show a similar policy where that someone, instead of purchasing a car, decided, well, of course, I don't need a car, or I want to pay off debt. So this is a real example of a real person who had $231,000 of debt, and they decided to deposit $10,000 per year into their policy. Don't get hung up on the number. $10,000 is what they decided to deposit, but they could have decided $5,000 all year, $50,000 all year, $100,000. They could have decided anything they wanted to deposit. They didn't have $10,000 all up front. They could have decided to do $5,000 twice. $5,000 at the beginning and $5,000 6 months in. They could have done $2,400 per quarter. They could have done, $800 and change, every single month. Anything they wanted to do, you can put in this policies. So traditionally with this setup, how many years would it take you to pay off the debt? If all you were contributing was $10,000 a year towards your $231,000 of debt, well, it would take you about 23 years to pay off. We're going to go a little faster, and I'll show you how we do it. This example is called our map. Okay? The map is a tool to show you debt payoff that if you get started with us and you have debt, we will customize this map for you free of charge. But this current map is what a real person went through to accomplish their total debt payoff of $231,000. So you can see they have a few debts here. They owe Visa, they owe Discover, they owe the dentist, they owe Home Depot, Best Buy, Apple, Kohl's, Rooms to Go, they have a vehicle, and they have a house. Underneath the debts, you can see 4 things. So for instance, the Visa card, you can see that they owe $1,250. They pay $32 a month. The Visa card is charging them 23% interest, and if they just kept the Visa on that schedule, they'd have that Visa card for 72 more months. 72 more months, just over 6 years, right? For the Discover card, 80 more months. For the dentist, 45 more months. We're going to try to go a little faster. So here's how we do it. Don't get hung up. I know there's a lot of numbers. We'll explain it to you. The top right corner of the sheet says that they deposited $10,000 into their policy right away. And they were able to take out right away $5,292. When they did that, they were able to pay completely off their Visa card, completely off their Discover card, and they paid the dentist down from $2,622 down to $403 remaining. Because they paid the dentist down so far, just by making the normal payments to the dentist bill actually paid off just a few months later, about 7 months. They've just taken money from their banking system in order to use it to pay off their debts. And so they decided to be an honest banker. And if they would have borrowed money from a conventional or traditional bank, the bank would have put them on a payment plan. Now, they don't have to do that here, but they decided, sure, if that's what I would have had to do for the conventional banks, that's what I should do for myself. So when they pay off their Visa and Discover card, they decided, instead of just letting that $32 a month that they used to pay to Visa and Discover vanish, they wanted to put that back in their banking system. Revert it back to their banking system instead of just letting it vanish. And the reason they're doing that is because, again, that's what conventional or traditional banks would have made you do. Repay the money that you take. Don't have to here, but they've decided to do it. At the end of 1 year's time, remember that they still have to make the payments on all of these other debts. Just because you've got a banking system now and you can use it to pay off some things does not mean you don't have to pay your car note or your house note. So for the rest of the year, they just pay their debts, and here are the remaining balances after 1 year. To start the second year, they deposit $10,000 into their policy, and they're able to pull out $5,500 from their banking system. They also have repaid their banking system over the first year a dollar amount of $1,168, meaning they have $6,729 that they can take and spend and use from their banking system to do anything they like. So with $6,700, they decide to pay off Home Depot and pay Best Buy down to just $3,100 remaining. Because they've paid off Home Depot, they decided, sure, I'll take that $180 a month that I was going to Home Depot and I'll save it up. I'll put it back in my banking system so I can use it again at a different time. At the end of the second year, here are their remaining balances. The third year starts and they put $10,000 to their banking system and they can get out $7,400. They also have saved up, accumulated $3,800 that they've repaid themselves from all the debts that they've paid off for a total of $11,351. And with $11,351, they pay off Best Buy, pay off Apple, pay off Kohl's, and pay rooms to go down to $4,000 remaining. At the end of the year, here are their remaining balances, but let's not forget that they now have all of those monthly payments from all of those debts that they've paid off that they are keeping, that they're saving up, that they're putting back in their banking system so they can use it again at a later time. To start the fourth year, here's where it gets really fun. You put in $10,000 to your banking system, and immediately from your banking system, you can take $10,252 out of your banking system. What in the world just happened? Why can we get more money out of the banking system than we're even putting in? It's because all of the money for 4 years, $40,000, $10,000 a year that you've deposited into this banking system is still in this banking system earning interest. It's guaranteed to you, uninterrupted and compounding. And the money that you are taking to spend each year is not your money. It's not a withdrawal. It's the insurance company allowing you to take and spend their money while your money is growing. So $10,252 is what we've got in the fourth year, on top of the $9,660 that we've saved up. Remember, this is not extra money. This is not working harder, changing your cash flow, doing extra hours. This is money that would have gone out to Visa, to Discover, to the dentist, to Home Depot, to Best Buy, that now we're able to keep. So we have $19,912 that we can use to tackle debt. And so we're able to pay off rooms to go and pay off the vehicle. All we've got left is the house. Let's fast forward just a little bit. For the fifth year, the sixth year, and the seventh year, we deposit $10,000. In those years, on top of the money that the insurance company guarantees that we'll see and we'll get, that we can spend, we also have all of the dollars that we've repaid ourselves over that time for a total of $30,450, $30,920, and $31,000 to use each and every year. And with those dollar amounts, we actually completely eliminate $230,000 worth of debt in just 80 months. 6.5 years, every single debt is paid in full. paid in full. Every single debt paid in full. How happy do you think this person was? Extraordinarily happy, right? 6.5 years instead of 23. Did they do anything stupid? Did they lock their money up? Did they give up control of their money? Did they take any additional risks? No. They just use a dividend-paying whole life insurance policy like a banking system, like a bank does, instead of using a traditional and conventional bank. That's all they've done. Warren Buffett says it best. If poor people would just do what rich people do, they would not be poor anymore. Let's take a look at one of my other favorite tools so you get the gravity of what's happening. This tool is called a cash flow analysis. Any person who gets started with us is going to get this completely free of charge. The cool part about this particular tool is that this tool comes out before you sign on the dotted line and decide that you want a banking system. You actually get to see the values, the guaranteed growth, the cash values before you decide to continue. It's a huge deal. You don't have to take my word for it. It'll come directly from the insurance company. This policy is a $10,000 per year policy. It's actually the exact same policy we just looked at. The guaranteed cash value in each year is listed right there for you. $5,200, $5,400, $7,200, $9,900, $10,000, $300, $10,700. It just keeps growing. $10,000 a year deposited, and this is what your cash value is equal to. On this particular sheet, I've listed the death benefit as well, just so you can get a picture of what is also available as a tag-along benefit to your family while you're using cash values, you're using money, you're buying things, you're paying things off, you're accomplishing your goals, whatever you want. But it actually gets better. I told you that we only use dividend-paying whole life insurance companies. That means a dividend is kind of like a bonus that you'll get each and every year. And for every example you've seen in this presentation, I have not shown you that dividend. But now I will. The dividend is on top of what's guaranteed to you. Again, your insurance company guarantees, it's in the paperwork that you get to see, growth, uninterrupted on any money you deposit. The dividend is on top of that, and you can see it right there in the projected cash value per year columns. The totals are at the bottom of the screen if you like to look at that. Understand $10,000 a year for 20 years means that you've deposited $200,000 to this policy. They guarantee that you'll use $242,000, and with their bonus each year, plan on giving you $25,000 extra for a total of $268,000 that you can spend and use, that you can take out, that you can do things with, while your $200,000 is still in your policy, earning interest and growing year by year. This presentation is our cash compound Cracking the Code to Cashflow presentation. You can find us online at thecashcompound.com. I would love to talk with you, to talk to you about your situation, to help you understand how quickly you can accomplish your goals, to answer your questions about how these policies work and how this is possible. I would love to do it. Please email, call, text. I have a scheduler as well that I'm happy to send you if you'd like it. We can schedule something. Maybe if you want to have paperwork out, you want to get your spouse involved, your other family, anything you like to, I would love to talk with you. Before I go, let me give you some resources. This man, R. Nelson Nash, wrote the book called Becoming Your Own Banker, which is unlocking the infinite banking concept. This is where most of the information that we've talked about today comes from. It's in this book. I'm not selling the book. You can grab it on our website if you want to as a resource. We have a link directly to it. I believe it costs just around $20 or so on lots of those popular book websites. But if you're interested, read the book for yourself. You don't have to take my word for it. It is in this book what is possible. They give more examples, more explanation if that's what you're into and that's what you need to know. I also, one of our mentors and friends who have even taught me all that what I know about banking, Brent Kessler, and another agent friend of ours, Chris Noggle, have wrote this book, Mapping Out the Millionaire Mystery. I recommend this book to you as well. We want to see you succeed. We want you to be able to unlock the power of uninterrupted compounding while still using money. becoming your own banker, making all the money that you're then giving away, that you're now giving away to other people. And so, if you make it to our website, thecashcompound.com, we want to welcome you. We want you to be there. We want to talk with you. I'm so thankful that you stayed and walked through this presentation. Please reach out. If you have any questions, I'm happy to chat with you. Thanks so much.